taxes given the results of last night and taxes for Canadians who may be traveling to the United States or may in fact have dual citizenship. We're joined now by Matt Altro, President and Chief Executive Officer of MCA Cross-Border Advisors. Matt, thanks a lot for joining us. I know from some notes that you have shared with us that you were, like everybody else, watching last night with interest at the outcome. We know the outcome now. It is a Trump and Republican sweep. And one thing you were watching very closely was the U.S. estate tax. You were, if I understand correctly, your view was that a Kamala Harris Democratic sweep would have had significant implications for the lifetime exemption on the estate tax. What is your view now that it's clear that it's a Trump Republican win?
Great question, Paul. Well, there's a lot of people that can let out a big sigh of relief because the U.S. estate tax was at the top of the list when it comes to the impacts of this. Remember, U.S. estate tax is like a death tax. So ultimately, when you pass away in the U.S. and you have assets over the exemption, then you have to pay a tax of up to 40% when you pass away. That is a significant bill. Now, when Trump came into power, he doubled the exemption. The exemption's now $13.6 million. However, that provision was supposed to sunset as of January 1st, 2026. And if nothing happens in the law, that's in fact what's going to happen, catching many, many, many more Americans into the U.S. estate tax net. So now that we know something now, Paul. We know that it looks like we've got Trump in power, and it looks like the Republicans are going to get control of both the Senate and the House. So Trump has campaigned that he is going to make these tax cuts permanent. So in fact, that means that the exemption will not probably drop back down. And a lot of planning that Americans were doing to transfer assets out of their estate is no longer necessary. So, ultimately, that's one major factor. Now, this also could affect Canadians, right? Because the rule for Canadians who have just U.S. assets is that if your U.S. assets are over $60,000, but your worldwide is over the exemption, you might also have U.S. estate tax on your U.S. assets. So that's, a U.S. property or U.S. stocks in your name personally. So estate tax planning still could exist because ultimately you could be over those numbers. Planning should be done. Maybe transfer your U.S. property to an irrevocable trust. Maybe your U.S. shares of stock, all those advisors listening out there, U.S. shares of stock could expose Canadians to U.S. estate tax. Good solution, transfer assets to a Canadian holdco. You no longer own U.S. shares of stock in your name personally. You own shares of a Canadian holding company, which owns U.S. shares of stock. So ultimately, very interesting results.
Hey, Matt, we've seen a number of our clients, their children, adult children, moving to the U.S., taking jobs in the U.S. They may have TFSAs, they may have RRSPs, first home savings accounts. What should people think about there if their children are moving to the U.S. for jobs and becoming non-residents, for example?
Yeah, I got a lot of clients get a job maybe in California for tech, or their doctors moving there. Ultimately, the Canadian-U.S. tax systems are so different. A TFSA, which is a no-brainer for a Canadian, the IRS doesn't like the TFSA. It ultimately doesn't give it the tax-free nature that you would get as a Canadian. So American, if you move to the U.S. and you have a TFSA, you probably need to sell it. You need to liquidate it before you move, because even the IRS may consider it a foreign trust, which is a complicated concept as well. If you have RESPs, tricky, people are saving for their education. That one, you probably, if your kids are no longer Canadian residents, you can't leverage the benefits of an RESP. So you might want to wait and see there, but do not contribute once you're a U.S. person. The big one that's interesting is the RRSP. You can keep your RRSP if you move to the U.S., but here's the big win. Canada is much nicer to a non-resident than they are to their own residents when it comes to RSP planning. We put money in RSP, we get a deduction, it grows tax deferred. But when you take the money out, as a Canadian, we pay a pretty high rate of tax, maybe up to 54%. Canada is much nicer when you're a non-resident. Instead of the 53%, Canadians who move to the U.S. can pay 25 or even 15%. If you've got a couple million in your RSP, that's looking like an $800,000 savings to your retirement nest egg.
Wow. And that's great insight, Matt. What about U.S. citizens living in Canada? Some of our viewers, no doubt, fall into that category. There's about 1 million U.S. citizens living in Canada. What should they be thinking about?
Great point. Yeah, again, U.S. citizens in Canada, not only should they not do the TFSA, but the RRSP planning is tricky because the U.S. doesn't give a deduction on the RRSP. And I'll tell you, there's just so many income tax traps out there. And when you don't get a deduction on the U.S. side, well, is that going to work? Well, I'll tell you, usually it does, because in Canada, you get a deduction, and in the U.S. you don't. But because the Canadian tax is so much higher on the RSP, you're likely still to benefit from that. But if you're a U.S. citizen in Canada, there's also other rules. The IRS taxes capital gains differently. Do you know that there's a difference between a short-term and a long-term capital gain in the U.S.? Canadian advisors also don't realize this often, that if you sell an asset and you're a U.S. person and you've held it less than 1 year, you don't get the preferential capital gain rate in the IRS view. So you got to be careful to make sure that you're timing your sales at the right time for year-end planning, and also just making sure that you're looking at cost basis for both countries, because the U.S. cost basis for when you sell a stock could be different than the Canadian. So that's also a tricky one.
Okay, we're out of time, but we're going to squeeze one more question in. Barry Schwartz has got a topic he really wants to put a question to you. We need Barry to ask the question quickly, and we need you to answer it fairly quickly, Matt.
What's going on with the capital gains change in Canada? Is this happening?
Well, yeah, I mean, the capital gains change looks like it's definitely a done deal. 67% inclusion rate. I'll tell you, I got a lot of calls for Canadians who wanted to move to the U.S. and still do because of this high rate of tax. And ultimately, you know, what that means is that you potentially, if you're going to exit, you got a departure tax that's coming. But there's a lot of planning that you can do to avoid departure tax, defer the departure tax, planning to deal with the departure tax, reduce it. So, you know, definitely come and discuss it, because there's a lot of interesting planning that we can do in advance.
Matt, thank you very much for this conversation. That's Matt Altro, President and Chief Executive Officer of MCA Cross Border